Hey everybody, welcome to another episode of The Executive. We're at the Venture Summit today where we're so fortunate to be joined by Joanna Arras with Baird Capital, who's a partner there. And the Venture Summit is a place where Colorado entrepreneurs are meeting with investors who are coming from all over. Joanna's coming from Chicago. Joanna, so good to have you here today. Thanks for taking the time.
No problem. Glad to be here.
So tell us a little bit about Baird Capital. It's obviously it's a venture capital group as well as a private equity firm, but you're on the venture side, is that right?
Yes. So Baird Capital is the direct private investment arm of Robert W. Baird & Co., which is a Milwaukee-based mid-market investment bank and private wealth management firm. At Baird Capital, we have two fund families. We have a global private equity fund family that invests in traditional lower middle market buyout opportunities. And then I'm a partner on our venture capital fund, where we invest in U.S. mid-stage businesses in the B2B tech and services sectors.
In mid-stage, is that Series A, post-Series A?
You know, it's what looks like a Series B traditionally.
That is
always changing. That is always changing, but it's usually companies that have between 2 and 15 million of revenue and are still growing rapidly and, raising VC dollars.
So we were talking about this a little bit before. This market's kind of crazy. Crazy is another
word
for bad.
Yeah.
What are, you've got your own companies that, you're trying to help through this stage, and then there's also looking for new deals. We'll talk about that. But for your companies now, how do you advise them through a market like this that's so challenging?
Yeah. So I say, hopefully, without my crystal ball, that the most challenging time for our companies in this market, I think, was actually budgeting season last year. So December, January was tough. There was not a lot of optimism. Now we sit here today, stock markets are up 30, 40%, whatever year to date. Oh yeah, everything's fine, resolved. But there was not a lot of optimism. There was a lot of murkiness about what 2023 would look like in terms of revenue growth, budgets from their customers, and importantly, fundraising markets, right? Because most of our portfolio companies are cash burning, so need continued access to either debt or equity. And around the turn of the year, when we're all going through those budgeting cycles, it was really hard to think through anything more than 3 months out. So it was a tough budgeting cycle with, I think, a lot of companies taking a hard look at operating expenses, cost plans, things like that. And so now to see how the first few months and quarters of the year are coming in, and that indeed their customers are still spending money, maybe at a little bit of a slower rate. A lot of enterprises on their software spending have been guided to, wait to see how the quarter comes out, so sales processes are elongating. But I do think there's a hint of optimism coming back. So now it's about, focusing companies on where are real, true, sustainable growth opportunities that are available to us in a little bit more of a cost-efficient manner than maybe have been pursued over the last couple of years.
Yeah, and that's been such a switch, right, where it's grow at all costs, just throw money at things, right, to where can we save dollars, right? How do we grow responsibly? Do we need to get to profitability if we can't raise? How do you, those conversations were probably pretty hard to have with, founders and, a little bit of reality check. How do you approach those?
Yeah, I think the best approach is to always try to look 6 to 18 months out, right?
Yeah.
If you're having a conversation where you're running out of cash or you've been surprised by some churn in your revenue base and all of a sudden your runway has consolidated, that's when things are extremely tough. So it's always best, I think, to scenario plan and ideally do it as far out in advance as you can. Now, traditionally, VC financings only capitalize a business for 18 to 24 months, right? So a lot of it is about extending runway, or a lot of those conversations earlier in the year were about extending runway. And then importantly, I think a lot of companies turn to their existing investor syndicates to see if they didn't have a comfortable amount of runway on the balance sheet, could they extend it with a topped up inside round, an extension, something like that. We've been seeing a lot of those types of financings, again, inside led extension type equity rounds so far this year.
Just to get to them where the market has hopefully improved and the revenue can start to increase.
Yeah, so back to, hopefully where you're stringing together multiple quarters of strong revenue growth, of top KPIs or other unit economics that new investors might look at, because I don't think, one quarter is enough that a new investor wants to see. They want to see 2 to 6 quarters of that kind of stuff.
It's tough in the last few quarters.
So there has been some buying time to see if the fundraising market, multiples that investors are willing to pay, new investors are willing to pay, will improve, in 6 months or so. But I'd say that was hopefully, kind of the name of the game in the first half of 2023. And I hope that the second half of 2023, we'll be starting to see, again, more of those quarters be strung together and hopefully have a little bit of a trough behind us.
And you're obviously looking for new opportunities at the same
Always.
time. What are you seeing as you look at, companies, deals, however you want to call it, in this market? Are you seeing a lot of scrappiness? Are you seeing a lot of new innovation to give you optimism? What are you seeing?
Yeah, so I'd say that the innovation and entrepreneurial spirit has not wavered among companies. What has changed is approach to capital efficiency and also approach to partners. And that means, who they're selecting from an investor partnership perspective, who they're, selecting from a channel partnership opportunity, other, kind of even customer partnerships, things like that. I think that there has been a little bit of this, flight to quality, right? And on the deployment side for us too, that's what's coming to market. To fundraise are really the highest quality companies, because they're the ones who can still demand, more premium
price,
multiples, right? And don't necessarily have to work through the concept of a flat round or, heaven forbid, a down round, something like that. So,
and what are you looking for in these? It's probably so hard to look, in these early stage companies. Maybe with a B, you have some data to look at, but what is whether it's your thesis or how do you view a company when you're looking to invest?
Yeah, I really look for 3 main things. One, I look for a large and growing market, which even in times of these kind of macroeconomic uncertainty, you should still have a good sense of. So that still feels like we're able to diligence that in a, quote, normal way. Then you look for, product market fit. And as you said, at the B stage, we do have financial information or financials to diligence. So we do have, cohort analyses we can run. We can take a look at churn and retention trends, expansion, stuff like that. We have enough kind of customer data to see if the product market fit is really validated through what people are buying from us. And then even at the B stage, I think even more so at the earlier stages, it comes down to the management team and the people, right? So, and those, it has to be high quality, but to me, high quality means they know their market and their buyer inside and out. I won't ever invest, I don't think, in a company where I know more about the market than the CEO or the entrepreneur, right? So they know the market inside and out. They can recruit and retain top talent. And, they're kind of along for the ride in a way, that they're hungry, they have alignment of interests, they're approaching the partnership in the same way as we are, which I know that's a lot kind of crammed into that third bucket of management, but it tends to be the most important, I think, in early stage investing.
And have you seen, the companies that you've invested in? Some have obviously done well, and some I'm sure you're frustrated with.
All have done well.
It evens out. What are the ones that you look back at and you're like, there were a couple of traits, either was the founder or something that you recognized of now you're going to use that going forward?
Yeah, I think some early indications of success, and this might sound generic, or I'm sure people might roll their eyes when they hear this, but a lot of that kind of the net dollar retention, right, and expansion within your existing customer base. Because it's not just, hey, can you sell a new customer, but are you proving your value prop, quickly enough, or do you have a fast time to value that not only are they renewing, but they're adding users, they're adding product features, they're willing to pay more. Right? It means that you've really proven out your ROI in an attractive way. And then, in a tighter market, you can grow your revenue without having the luxury of new sales, right? So we look a lot for that.
Where on the opposite side of it seems like you're concerned even if there's great revenue and that's growing, if there's a lot of churn in the customer base, that to you that's the big flag.
It is a big flag. It can be very market dependent. It's, I think, why a lot of investors don't invest in businesses that go after kind of the SMB space. We've had great success there, and aren't afraid of it. But the gross retention and the net retention does look different in an SMB focused go-to-market strategy rather than enterprise. Sales cycles are also different too.
Yeah, I'm sure.
So you do have to have some flexibility on those metrics.
And you sit on the board of a few of these companies. As the perspective of a board member, what's your perspective of it? Like, how do you, in your mind, how do you be a good board member? What's your role?
Ooh, how am I a good board member? You should ask the
founders?
companies I partner with. You should ask them if my view of it is the same as their
that would
view
be a good place
of it.
To start.
But I mean, really, again, this is going to sound cheesy. You're partnering with these teams and these companies for the long term. In venture, our average hold period is 7 years. So, but the diligence period pre-investment, maybe you're lucky if you have 6 months. Sometimes you're tracking the company for a few years, but I mean, in reality, you're spending, as a board member and investor, you're spending so much more time on portfolio management and board activities than you are evaluating the investment or, pursuing an exit or realization opportunity. So I think in all great partnerships, not just investment ones, you have to be adaptable and flexible, and it always depends. So what does that company need at that point in time? When you first invest at the Series B stage, they might need a lot of help with recruiting and recruiting key new executive leadership team members. Later on, they might need help with navigating the debt financing markets. They might need help with navigating M&A opportunities, creating new channel partnerships. Eventually, it's going to be providing a lot of advice and counsel on timing the capital markets, which is
tough to do.
It's annoying to say that can lead to a good or bad outcome, but it's true. It's true because it's gonna, that's gonna play into what kind of multiple you're gonna capture at exit, or what multiples you'll capture at different financing stages, but then ultimately at exit, and how much money is going in everyone's pockets and fueling their next business that they're going to start. So I think it's a lot of flexibility. Probably a little bit of therapy, sometimes both ways, I am sure. But really, it's making sure that you have, aligned interests and are viewing how you want to work together in a similar fashion.
And how important is it for these founders to look to you and for you to build these relationships so that you have the relationships with M&A groups, you have the relationships with attorneys or whoever it is, right? So that they can go to you and that you've already built that relationship base. Is that a thesis of Baird Capital to really build out and have that for your portfolio companies?
Yeah, a big I think point of differentiation for Baird Capital is actually being part of the broader Baird platform. Baird is a 5,000 employee plus organization that covers 800 plus public stocks, has a massive investment banking department, so just has very wide-reaching corporate and executive relationships and networks, and we're able to tap into that. Which is, I think, really exciting for a 7 to 8 person venture team, based in Chicago.
Those could be customers, those could be connections. Yeah,
absolutely. But yeah, I think of course, I would think that an entrepreneur wouldn't want to bring someone on to their board solely because of the check that they're writing. It has to be the value add, and I do, even though all of us VCs talk the same and probably sound the same, especially in intro calls, we do have different personalities, we have different investment styles, we have different value that we're able to bring. So ideally, a CEO is also, creating a board and a governance structure that has a decent amount of diversity around the table too.
I'm sure in your role, it's also very hard to not get bought into some of the hype of certain industries, right? We can name a few right now, but are there any that you're really excited about that you think are beyond the hype?
Yeah, one industry that I've remained very bullish on and will continue to is supply chain and logistics. I think that historically that's been an industry that has not had access to a lot of data, certainly digital data. So there's been a massive opportunity for software adoption. And then when you layer in what's happened over the last few years with, a true on-demand economy, not just an app-based on-demand economy, but, like products and goods and delivery and all of that, I just think that's an ever-changing, rapidly evolving kind of sector or subsector that's going to continue to attract a lot of VC dollars because there's a ton of opportunity there.
And maybe that one is probably a little less hype than the AIs, the Web3s, right?
Yeah.
So maybe you can kind of sneak in there when some people are not
Sure.
looking as much, probably, right?
Yeah, so yes, absolutely. Yeah. Absolutely. And the AIs, the Web3s, I'm not a naysayer. Yeah. To be clear, I'm not a naysayer. It's really interesting because what you've seen shift probably over just the last year is that these used to be marketing terms. You'd go to conferences, you'd hear company pitches, and everyone had to have AI in there somewhere, but often it wasn't true AI, or they had something, we're machine learning based, and like, okay, tell me more about that. And I think it was often a marketing term, and now what you're seeing is real, true, valid companies, built natively here that are emerging as, we're not going to call them category leaders yet, but category definers to help move this into something that's like monetizable, if you will.
Well, I want to end with two last questions. Mm-hmm. One of them you talked about, it's difficult for VCs, sometimes you sound the same, right? But you can differentiate, right, as many truly are in your partners. But it's the same. It's the same for a lot of founders, right? Yeah. You hear pitch after pitch after pitch. And how do founders get your attention as a VC when you're hearing that many pitches?
Yeah, I think so. First, having a very intimate understanding of the sector that you're going after and really having a connection to the voice of the customer comes through. That you're not just an entrepreneur who's interested in starting a company to solve a big problem and make a bunch of money.
Yeah, you can tell.
There's a connection to the value that you are delivering. You know it, you can talk it, you've lived it. And I think that will ultimately wind up in product differentiation too, and will be rewarded. But then, I hate to say it again, it comes down to the relationship aspect, right? So not everyone is going to like me, and I'm probably not going to like everyone, right? So, and again, these are long-term partnerships. You have to click both ways, and it's a bad analogy to say, don't you know on a first date?
Right. Pretty quickly.
If it's going well or not. You probably do know pretty quickly both ways if you want to have a second conversation and see if it can lead to something.
Well, speaking of second conversations, and this is not the first Venture Summit, and it seems like people keep coming back here. Mm-hmm. So clearly the conference is doing something right. Why is Baird Capital here? Why is it important to be here in Colorado?
Yeah, so at Baird Capital, we love investing in mid-country businesses or in businesses that are in traditionally underserved markets. There's tremendous talent available. They tend to be a little bit more capital efficient. There tend to be more accessible valuations, which aren't just better for me as an investor, but I think are better for the entrepreneurs and the management teams and all their employees, all the common sharekholders as well.
Makes them be able to raise later at a reasonable valuation.
We'll all make more money together in the end. And Colorado has been one of those key focus markets for us. We've made a few investments here. They've done really well. Again, the talent pools here are undeniable. The quality of life here is really great. And so, again, the ability to attract and retain talent, I think, will always exist here. And so this has been a key geography of focus, if you will, for Baird Capital for, 5 to 10 years. And I don't see that letting up. And this is, I think, the best venture conference in the region.
That's great to hear. And it's great to hear that feedback on Colorado, that you've had a few companies that have done really well. Mm-hmm. I've only been here 8 years, or maybe I say only, but we've seen, and now it's a long time. I feel like I've been saying that for the last 4 years.
Yeah,
but
the last 4 years didn't count.
That's true. We've lost at least 3 years.
Yeah.
But we've seen so many great companies. When I first came out here, there were just a couple ones that put us on the map, and then it was, every quarter there was a big one. So it's great to hear that feedback coming from Chicago as well. So we appreciate it.
Yeah.
Well, thanks for taking the time. Mm-hmm. Hopefully you find your next big one here at this conference.
I hope so too.
So thanks for taking the time, and we look forward to seeing you again here soon.
All right, thank you.
Thanks, Joanna.